Hi, and welcome to OSFI's Regulatory Affairs Division webcast. I'm Judy Cameron, Senior Director of Regulatory Affairs and Strategic Policy. It's my pleasure to be your virtual host. The last RAD seminar was in February 2020, just a month before the first COVID lockdown. It seems like a lifetime ago. We look forward to your feedback on this new virtual format. It offers definite advantages, such as inclusivity and efficiency, as we can accommodate more participants and travel time is irrelevant. However, we do miss the opportunity to connect with you face-to-face. Before we get into the meat of our agenda, I'll say a few words about what OSFI was up to over the past 16 months, which really focused on our response to the COVID-19 pandemic. In spring 2020, as the magnitude of the pandemic became apparent, market volatility spiked to levels not seen since 2008. Debt markets froze and an oil price war erupted. Given the impact on business activity and consumer confidence, we all anticipated that the resilience of the Canadian financial sector would be tested. OSFI immediately restricted increases in dividends, share buybacks, and executive compensation, and reduced the domestic stability buffer in order to support the largest bank's ability to supply credit to the economy during the period of disruption. We also suspended all policy consultations so that institutions and OSFI could focus on the situation at hand. Finally, we made a series of temporary adjustments to certain capital and liquidity requirements to ensure they remained appropriate for the extraordinary conditions and did not undermine the various government support programs. However, by summer, it was evident that the Canadian financial institutions were in fact very resilient, and we gradually began to unwind temporary measures as they became less relevant. For example, the special capital treatment for loan deferrals ceased shortly after banks' deferral programs ended last autumn. We also restarted our policy work and gradually returned to business as usual, albeit in a work-from-home environment. You will hear more about our policy agenda in our second session. What does the future hold? As many of you may be aware, Superintendent Ruden's term ends in just 12 days, so OSFI is facing even more uncertainty than many of you. We're waiting for the next superintendent before we make any concrete plans about our workplace of the future. However, it's safe to say that it will involve some sort of hybrid model. And otherwise, our mandate, our strategic priorities remain the same. Next slide, please. So, Superintendent Ruden leaving is obviously a big thing, but for us, there have also been some big staff changes within the Regulatory Affairs Division since we last met in February of 2020. In July of last year, Joanne Marsden left OSFI for a 2 to 3 year term with the Basel Committee for Banking Supervision. Teresa Hinz, who led the Legislative Policy and Interpretations team at that time, took over leadership of the Strategic Liaison and Policy team. Jean-Pierre Girouard moved from approvals to the Legislative Policy team, and Patrick Clermont returned to the Regulatory Affairs Division to lead the approvals team. So now I'll turn it over to that team, starting with Jean-Pierre Girouard and Ryan Cassidy, who will give us an update on legislation. JP, Ryan, please take it away.
Okay, thank you, Judy. Good afternoon, everyone. So it's a pleasure to be here at our first virtual seminar. I will be delivering my presentation in French, so please select the English channel if you'd like to hear the interpretation into English. Next slide, please. Alors, bonjour à tous.
Hello, everyone. So my colleague and I will give you an update. We're going to start with the change in personnel that we went into the group, and then we're going to talk to you about some changes on which we have been working. We're going to talk about the virtual reunions and institution. When we take a look at line number 12, and finally, we're going to have a guideline dealing with the transitional issues in relation to the Part 13 of Insurance Companies Act, and finally, an update on the legislative changes related to the Canada-Mexico trade agreement. Next slide, please. So first of all, there are some changes in the group. As Judy mentions, I took over the leadership of the group last summer. I'm very happy to be here and joining the team. Next change, the other change is as Laurent Sacripanti, with whom many of you had the pleasure of working with, who was in the approvals group and previously the policy group. He joined us a few months ago, so we're very happy to have him among our team. And finally, I know that this is a small team. There's a vacant position, and we're just about hiring someone in the next few weeks. Next slide, please. So the legislative compliance, task of supervising the representative offices of foreign banks used to be the responsibility of the deposit-taking institution supervision sector. And this function was carried out from the Toronto and Montreal offices. And many of you may be familiar with these representative offices, but those who are not, a representative office is an office that a foreign bank may establish with the permission of the superintendent to carry out the promotional liaison activities. These are the only two activities that are allowed. So since they're the only two allowed, a foreign bank may not, through such an office, conduct businesses in Canada. And they can't, for instance, negotiate or give loans through this office. So the activities are strictly permitted are promotion and liaison. In the supervision of these offices, there's an exercise of legislative compliance. So we're ready to take measures if there was be let's call it a catastrophic environment through this for this bank. But in a normal situation, it is a legislative compliance exercise because our team is responsible for it. So we seem fit to transfer the task of supervising the representative offices to the group. So over the next year, our team will be contacting each representative office so that we can introduce ourselves and
Thank you, Jean-Pierre. Good afternoon and welcome, everyone. So also on the legislative compliance front, we recently published a name request webpage. Subject to certain exceptions, the FERFI statutes restrict the use of certain words in company names. For example, restrictions in the Bank Act on the words bank, banker, or banking apply to all non-bank companies and businesses in Canada. Name restrictions in the Trust and Loan Companies Act and Insurance Companies Act apply only to federal companies. Now, the Insurance Companies Act restricts the word insurance and similar words, and the Trust and Loan Companies Act restricts the words trust and loan and similar words. Federal, provincial, and territorial company registries are responsible for approving company names. Now, where the proposed name contains a word that is restricted by the FERFI statutes, these registries may direct applicants to OSFI. In 2020, we published a name request webpage that includes an application form and related guidance, including frequently asked questions. The intention here is to make the process for receiving name requests from non-FERFIs more efficient and transparent. Next slide, please. Now I'll touch on amendments made to the statutes in the recent legislative review, specifically in respect of fintech and infrastructure, as well as related regulations. Now, we've mentioned these amendments in past seminars, so this will be a bit of a refresher for everyone. But I'll cover them again here, as the amendments will result in revisions to legislative guidance, which I will get into on a later slide. So first up, fintech. As you're aware, the FERFI legislation currently allows financial institutions to provide financial services through technology, but limit them from undertaking more general commercial activities. Now, the June 2018 FinTech amendments address the growing prevalence of FinTech by permitting FERFIs to more broadly engage in such activities and to invest in entities engaged in such activities on an indefinite basis and without ministerial approval. With one exception, these amendments are not yet in force. The exception is the power for FERFIs to provide identification, authentication, and verification services without ministerial approval. Again, the FinTech amendments not yet in force are set out on this slide, and they will come into force when related regulations are complete. These regulations are being developed by the Department of Finance and will impose parameters around the use of some or all of the permissions set out on this slide. And OSFI is assisting the department in developing these regulations, and work in this regard is ongoing. Next slide, please. The infrastructure amendments. So the infrastructure amendments will permit life companies and fraternal benefit societies to make substantial, including controlling investments in permitted infrastructure entities. The activities of a permitted infrastructure entity will be limited to investing in infrastructure assets and engaging in other activities, all as set out in regulations. Again, the infrastructure investments amendments are not yet in force. And as with FinTech, this new investment power will come into force when the related regulations are complete. And again, as with FinTech, these regulations are being developed by the Department of Finance. The regulations will impose conditions on the use of this new power, prescribe permitted activities for an infrastructure entity, as well as assets that qualify as infrastructure assets. And again, OSFI is assisting finance in developing these regulations, and work is ongoing. Next slide, please. So the FinTech and the infrastructure amendments will necessitate revisions to two of our advisories, our legislative advisories, namely the advisory on substantial investments and the advisory on the legislative framework for foreign banks. These advisories provide an overview of how we administer and interpret the substantial investments regime in the FERFI statutes and parts 12 and 12.01 of the Bank Act. And as I mentioned, we'll be revising both of these advisories to take into account the FinTech and infrastructure amendments. So again, in respect of FinTech, as I've mentioned, these amendments will permit FERFIs to make substantial investments in entities engaged in activities that relate to financial services and majority financial services. So these amendments will be reflected in both the substantial investments advisory as well as the advisory on the legislative framework for foreign banks. Now for infrastructure, again, the infrastructure amendments will permit life companies and fraternal benefit societies to make investments in permitted infrastructure entities. The parts of the substantial investments advisory applicable to life companies and frats will accordingly be updated to take into account this new power. Next slide, please. We're also planning on publishing a new ruling related to asset transaction approvals. Now, this came out of a specific fact situation that was presented to us. So for the facts, a FERFI wanted to acquire an entity by way of temporary investment, and the size of this acquisition would exceed 10% of the FERFI's assets. First, a word on temporary investments. For the acquisition of an entity that would have otherwise required a prior approval under the regime for substantial investments, the temporary investment power allows a FERFI to acquire that entity without seeking prior approval. Now, under temporary investment, the FERFI may only hold the entity for a limited period of time, after which it would need to divest or seek approval to hold the entity permanently. And for large asset transactions, Section 512 of the Insurance Companies Act and its equivalent provisions in the other FERFI statutes generally provide that prior approval is required where a transaction exceeds 10% of the FERFI's assets. However, Section 512 contains an exception to this approval for large asset transactions where approval under the legislative regime for substantial investments is required. So given the exception, the question we considered was whether the FERFI needed an approval under the large asset transaction provision prior to making the acquisition. That is, could the exception be relied upon where the applicant intended to acquire the entity as a temporary investment, where future approval would be required under the legislative regime for substantial investments in order to allow the FRFI to hold the entity permanently? Now, our view is that the exception was not available in these circumstances, such that the FRFI required the large asset transaction approval prior to acquiring the entity. The exception to the approval would be available where the FRFI has sought and received prior approval under the substantial investments regime, thus avoiding multiple approvals for the same transaction. Next slide, please. I'll also say a few words on virtual meetings. The FRFI statutes do not generally provide for virtual meetings of shareholders, policyholders, or members. That is, they don't provide for the holding of these meetings without an in-person component. That said, there are provisions in the statutes that provide that a court may order a meeting to be held in the manner that the court directs. So for example, a court may direct that a meeting be held entirely virtually. Early on in the pandemic, and more recently as we've passed the year mark in the pandemic, numerous FRFIs have sought and received court orders to hold virtual annual general meetings. Where a court order is sought, the statutes require that notice of the court application is provided to the superintendent before the hearing, and that a copy of any court order is provided to the superintendent as well. The legislation also provides that the superintendent may appear at the hearing. Now, to date, the superintendent has not appeared at any of these hearings. I'd also note that the government's recent budget proposes to consult publicly on the issue of virtual meetings. Now, it may be that this could include considering legislative amendments that would specifically provide for virtual annual general meetings and other meetings of shareholders, members, or policyholders. Next slide, please. So in 2020, we also removed some transitional guidance related to Part 13 of the Insurance Companies Act from our website. Amendments made to Part 13 in 2007 clarified that the framework for foreign companies is based on the location of business activities. As you know, Part 13 applies to the insurance business in Canada of foreign entities, that is, foreign insurers operating in Canada on a branch basis. Amendments made to this part in 2007 clarified that the framework is based on the location of their business activities rather than on the location of the risks they insure. This resulted in significant changes for many foreign insurers. Once the liabilities were removed, the assets supporting those liabilities were no longer required in Canada. So to assist industry in understanding and implementing requirements resulting from the amendments, OSFI published transitional information and guidance to help branches manage this change. These documents outlined a process to determine where the liability should be recorded as business in Canada and the process to remove those policy liabilities where the business activities did not support the liability remaining on the books of the Canadian branch. In 2020, these guidance documents were removed from our website as they are no longer relevant. In particular, given that the amendments came into force more than 10 years ago, and the fact that these documents were intended to be transitional in nature. Now, please note that our advisory on the insurance in Canada of risks remains in effect. This advisory provides guidance on key indicia to consider in determining, for the purposes of the Insurance Companies Act, whether a foreign entity is insuring in Canada a risk and how OSFI will apply these indicia to a particular business model. Next slide, please. So lastly, I'll briefly speak to the Canada-US-Mexico Trade Agreement, or CUSMA, and related amendments to the record-keeping requirements in the FERFI statutes. The FERFI statutes currently require that all FERFIs keep certain information and records in Canada. CUSMA, which came into force July 1st, 2020, results in amendments to the FERFI statutes effective approximately 1 year after the coming into force of the agreement. That is on June 30th, 2021. So these amendments provide that FERFIs covered by CUSMA and certain other trade agreements will no longer be required to maintain certain records in Canada, provided that OSFI has immediate, direct, complete, and ongoing access to information processed or stored outside of Canada. In terms of the impacted FERFIs, this would include FERFIs in the categories of Schedule 2 and 3 banks, Schedule 3 banks being branches, foreign insurance branches, and foreign-owned insurance companies, and trust and loan companies. And Canadian-owned FERFIs operating in the US and Mexico will receive reciprocal treatment with respect to data localization requirements in those jurisdictions. So that does it for my portion of the presentation. If we go to the next slide, again, happy to take any questions, and I'll pass it over to Brandon Nian to facilitate any questions and answers. Thank you.
Thank you, Ryan. Thank you, Jean-Pierre. My name is Brandon Nguyen. I'll be the moderator today. And so we will now take a few minutes to answer any questions that you may have. Please feel free to submit your questions and vote for questions on Slido to the right of the video, or use login information provided to access slido.com in another browser or your mobile device. So we'll just hang on a moment. Okay, we have one question here, and maybe this will be directed towards Ryan. Does OSFI have any sense of the timing of the coming into force of the FinTech and infrastructure legislative amendments?
Thank you for the question. So while we are working with Department of Finance on the regulation making process associated with these amendments, we're not responsible for this process. It suggests that any questions on timing would best be directed to the Department of Finance.
All right, thank you, Ryan. Now just seeing if any other questions come up. Okay, again, probably for Ryan. Did that loosening of record keeping in Canada only apply if it is stored in the USA or Mexico?
Good question. Again, so Global Affairs Canada is responsible for this, so any detailed questions on this can go to them, but it applies to more than just, say, CUSMA, so the Canada-US-Mexico trade agreement. There will be an additional schedule, I believe Schedule 4, that is located in the Bank Act itself, that will list out the various trade agreements that would be, say, have the same kind of loosening of record-keeping requirements applicable to them. So I believe CETA might be another one, but there's again, not in force yet. But the list of all those trade agreements and then the applicable jurisdictions would be in that schedule to the Bank Act.
Thanks, Ryan. Okay, we have just a few more questions here. More coming on. I'm just going to give it a sec here. So, would FinTech entities include those associated with Bitcoin, such as cryptocurrency exchanges?
Yeah, they could very well include, say, Bitcoin or cryptocurrency related activities. The way that the legislative provisions have been drafted, it could be viewed as quite broad. in the sense that they allow a FERFI to engage in any activity that relates to the provision of financial services. Again, we don't have any expertise in interpreting these provisions yet, but I would say that yes, the crypto could likely fit in a fintech type category.
Very interesting. This question, not necessarily for Ryan and Jean-Pierre, but it got a couple votes. When is the new superintendent going to be announced?
I can take a crack at it, but we don't know. That would be up to the government to determine.
Yeah.
I think as the superintendent recently told us, you'll know when the public knows. So the answer is we don't know.
Yeah.
We just hope that it will be before June 28th, which is Jeremy's term ends.
Okay. Here we go. Can you comment on why information would be provided to finance instead of OSFI regarding fintech investments?
So again, right now, so OSFI, given say our role in respect to federal financial institutions, we can access information from FERFIs whenever we deem it necessary. So obviously, if we had from a prudential perspective, we required certain information in the context of FERFI investments in fintech, we would go directly to the FERFI and ask for it. Department of Finance, in terms of that information going to Department of Finance, I'm not deeply involved in those regulations, but it would be more to assess from a policy perspective. So in terms of how far FERFIs are going into this space, I think that would be one of the primary drivers in terms of this information being provided to finance, because at the end of the day, this is kind of loosening up that financial commercial barrier in a certain limited sense.
And Ryan, obviously, we can't comment on what may or may not be in the current copies of draft regulations.
Yes, correct.
Okay, thank you. I believe we answered this. Could you elaborate on sections of the FERFI statute requiring certain records to be maintained in Canada?
Oh, you're gonna have to give me a second. I believe in the Bank Act, I believe it's around section 238 is for preparation of records, and then section 239 is the place of records. So section 238 of the Bank Act, and there are equivalent provisions in the FERFI statutes. So section 38 specifies the preparation and maintenance of certain records, and section 239 provides where those records shall be kept. So there's similar provisions in the bank. That's for your domestic banks. There are also similar provisions for foreign bank branches. And then these provisions are reflected in the other FERFI statutes for trust and loan companies and insurance companies as well.
Thank you. Is Interact considered infrastructure?
Is Interact considered infrastructure? A little bit of clarity would help if you're talking about infrastructure in the context of the infrastructure amendments, or is there something else that's meant to be get at here?
Maybe we'll put that out to whomever had submitted that. We apologize if we'll just need a little more clarification if you can add another question related to that. We can move on to the next one available. Does OSFI intend to update aspects of the substantial investments guidance not related to the new regulations as part of the planned updates?
Definitely something we will consider in the context of our updates. If there are, say, other areas of the guidance that need to be updated, the one of them that comes to mind is in the context of materiality thresholds for substantial investments. So I believe it's a couple years ago now, this materiality threshold came in that provided, if your investment fell under a certain threshold, then it would have otherwise required superintendent approval. If it fell under this threshold, you didn't need the approval. So that hasn't been reflected yet in the substantial investments advisory, but it would likely be reflected in the updates as well.
Thank you. And do you have any sense as to when this Schedule 4 would come into force?
So it should come into force on June 30th. I believe the way it was set up under CUSMA is that, 1 year after the CUSMA agreement came into effect, that those legislative changes would take place. So I believe it's June 30th is the date that, say, the new record keeping requirements for certain FER fees would come into force, as well as the related schedule.
Thank you. We have an update, thank you, on the question with respect to Interact considered infrastructure with regard to the changes.
Interesting question. It'll depend on how infrastructure assets and the activities of a permitted infrastructure entity are, say, defined in the regulations. So yeah, we won't know until the regulations are out.
Okay, thank you. A follow-on question. Please give an example of a transaction that a FER fee can do after these regs are in place.
Yeah, I can use an example from say on the fintech front, and I believe it was an example that Department of Finance may have used in their consultation materials in the lead up to these changes. Say, and I'll talk about one of these changes is the ability to invest in majority financial service entities. So, under the substantial investments regime, every activity of that entity must qualify as a permitted activity, and they're generally financial. They generally have to be financial in nature with some limited exceptions. You could have, say, the acquisition of a FER fee by an entity that is primarily engaged in some sort of, it's an app, and it's primarily engaged in, say, financial type activities, but it does have a sideline minority business that is food delivery, something like that. So right now under the regime, it would generally not qualify as a permitted investment because of that food delivery aspect. But under fintech, as long as it fits within this majority financial service entity definition, such an investment could be made and could be held permanently.
Thank you, Ryan. The next few are related to insurance. So can OSFI's name request webpage be accessed from OSFI's webpage? Yes,
it's a separate column. I don't have the webpage in front of me, but it is accessible from our say the external webpage.
Okay. And can you please review? Sorry, that disappeared. Can you tell us if the name request webpage and application form would also be applicable to the use of business names under section 44(3) of the ICA?
Sorry, I'm just refamiliarizing myself with 44(3). No, this would, the intention with the name request webpage is, so if you look at it from the Insurance Companies Act perspective, obviously federal insurance companies can use the word insurance in their name. But then what the legislation says is any other federally incorporated company, subject to limited exceptions, cannot use insurance in its name. So you're looking at it from that perspective, where, say, a non-federal insurance company is looking to use insurance in its name.
Thank you very much, Ryan. And is OSFI's current position that FER fees may not hold virtual meetings without a court order? Does this square with current prohibitions against large gatherings?
Yeah, and again, it's an interesting issue, and it's a complicated issue in the context of pandemic restrictions. If you look at it from the legislation perspective, yeah, the legislation doesn't appear to provide for the holding of, say, meetings without an in-person component. And that's reflected, I think, in the fact that, you know, a number of FERFIs on this basis have sought and received court orders to do so. Now, I know that under the Canada Business Corporations Act, which has very similar meetings provisions to the FERFI statutes, there is a provision there that that provides that, you know, if it's in accordance with the company's bylaws, a virtual meeting can be held or a meeting can be held entirely virtually.
Thank you very much. Okay, I think we're at time. These are all the time we have for these questions. So we thank you very much for submitting those questions. And we will now move along to our next presentation with an update on regulatory approvals. My colleague Patrick Claremont will begin. Patrick, take it away.
Thank you, Brandon. Good afternoon or good morning, depending on where you're joining us from today. It's a pleasure to connect with you and to introduce you to the regulatory approvals portion of our annual seminar. Next slide, please. So as part of my presentation, I will quickly introduce you to our team, and I will provide you with an overview of our volumes for our 2020-2021 fiscal year. Susan Lucas, Director of Insurance Approvals, will then address common questions we get with regards to timelines of the approval process. And finally, Brandon Nguyen, Director, Deposit-Taking Institutions Approvals, will share some of our observations over the past year, which we hope you will find useful in your future applications. Next slide, please. As part of today's seminar, each team within the Regulatory Affairs Division is presenting its org charts. So approvals is comprised of 3 groups: DTI approvals led by Brandon, insurance approvals led by Susan, and Securities Administration and Reporting Unit, or SAR, led by Jason Oiko. Those of you who have been working with us for some time will recognize several names here. And I will point out that, as it was mentioned previously, I started in my current role as MD of Approvals in July. I was very pleased to come back to this area of OSFI, which I know and find highly stimulating. Uday Reddy, who's a manager in our DTI approvals group, joined earlier last year. And we also have Shad Gafour, Cora Duke, and Jordan Crawford, who joined since our last seminar. Next slide, please. So a bit of background for those of you who are less familiar with regulatory approvals. So the FERFI statutes require that a FERFI obtains the superintendent and or the Minister of Finance approval prior to entering into certain transactions, establishing an institution, or engaging in certain activities. The approvals team mandate is to manage the approval process, analyze proposals, and make formal recommendations. We also provide advice on the application of OSFI's legislative intervention tools. Superintendent approvals include, for example, all related party transactions requiring approval, share redemptions, and acquisitions of unregulated lenders. Such approvals tend to be exclusively prudential in nature and are without significant public policy considerations. Under the Bank Act, the Trust and Loan Companies Act, and the Insurance Companies Act, there are also a range of ministerial approvals. In general, these cover major actions that shape the financial services sector and that have significant policy implications, such as new entry applications, like incorporations or creation of a foreign branch, as well as mergers and acquisitions. So in the case of both ministerial and superintendent approvals, OSFI's approvals group is the single point of entry for all processing of these applications. We have a well-developed process that involves working closely with key stakeholders within OSFI, as well as our colleagues at the Department of Finance. During our 2020-2021 fiscal year, our regulatory approvals group processed a total of 123 approval cases, as opposed to 146 the previous year. This represents a 16% decline. And we suspect that this decline in volumes is a result of FERFIs putting on hold or postponing their plans in light of COVID. Next slide, please. So we present here our most frequent approvals. I'm not going to spend a whole lot of time here, but for our 2020-2021 fiscal year, our most frequent approvals, all superintendent approvals, were redemption of debentures, assets in excess of 10%, exemption from proxy solicitation, substantial investment, and amendment to orders. Next slide, please. Since December 2019, the Regulatory Affairs Division replaced the Insurance Supervision Sector as administrator of the Securities Administration process. The activities of our approvals team and those related to the Securities Administration are similar in many respects, and this change is delivering some efficiencies for both OSFI and the industry. Our SAR unit reviews and approves trust agreements for insurance companies and deposit agreements for foreign banks. It also administers the process related to OSFI's approval for the release and vesting of assets in either the vested asset accounts, that's for PNC and life insurance branches, or the foreign bank branch deposit accounts for foreign bank branches. SAR also reviews and accepts letters of credit before they may be used as collateral for capital purposes. And finally, it administers reinsurance securities agreements to ensure domestic insurance companies are eligible for capital or asset credit related to unregistered reinsurance if they hold collateral in Canada. We're presenting here volumes to request to either vest non-approved assets or to release assets, also known as Form 298 requests. As shown in blue for last year, SAR processed a total of 458 of those requests. We're also showing here in gray the total of new letters of credit and other arrangements that we processed, 135 in total for last year. So a busy year for SAR. In addition to dealing with this historically high volumes and meeting its service standards, SAR launched public consultation in late March of this year regarding proposed changes to the vested assets regime for insurance branches. The feedback of that consultation, so thank you to all of you submitted feedback, has been largely positive. We are reviewing it in details and we expect the final update to be published this summer. Looking ahead to the fall, the SAR group will continue its work modernizing more of its processes, so stay tuned for further requests for feedback. I will now turn the floor to Susan. Thank you.
Thank you, Patrick. And we wanted to spend a few minutes today to talk about timing. So why would that be? Specifically, we've received some feedback recently, and we thought this would be a good time to discuss this topic. Specifically, in 2018, there was a financial institution survey and a follow-up interviews with CEOs of financial institutions, specifically about OSFI's approval process in May 2020. Some of the comments and feedback that we received from that survey and the interview were that sometimes people had mentioned that they don't understand why the approvals process takes as long as it does. And from their viewpoint, it appears to be getting longer. Sometimes specifically with their approval, my approval is not granted until close to the requested date. And if the timeline is extended, albeit for good reason, I don't appear to be notified until very late in the process. So today we're hoping to take a few minutes, and this would be an opportune time, we thought, with all of us together, to talk about some of the factors that go into the time required, and also to discuss some possible solutions. Next slide. So to provide some context at first, we've put together a slide where we've taken some of the most popular ministerial and superintendent approvals from last fiscal year, and we've measured the time from when we first received that piece of information to start the application to when the approval has been granted by the superintendent or the recommendation has been sent to the Department of Finance recommending the approval. And so as you can see, this information may be a little bit different than what you're used to seeing on OSFI's website related to service standards, where those figures are calculated based on the application receipt date to those end dates that I just discussed. From the figures in front of us, significant interest and control approvals took an average of 190 days, ministerial substantial investment approvals, 54 days, redemptions of shares or debentures, 37 days, the acquisition or disposition of assets greater than 10%, 102 days, and variations to the order to commence and carry on business or the order to insure risks, 85 days. Compared to the previous 2 fiscal periods, the significant interest and control approval has increased in terms of the time that has taken from the 2 previous years. Conversely, ministerial substantial investments and variations to the orders have decreased from the previous 2 last years. Redemptions have stayed relatively the same over the 3-year period, and there's been wide variability in the acquisition or disposition of assets greater than 10%. Specifically comparing it to the previous fiscal year, there's been a material increase. Next slide, please. Now, what are some of the realities in place really for any application? Well, first, before OSFI receives the application, there's a due diligence process within the federally regulated financial institution. Is this a good transaction? What transaction should we do? There's a due diligence. There's an internal approval process, which may be approval by management. It could be approval by the board of directors. An application is prepared and submitted to OSFI. So it will take time for the people working on this in OSFI to gain that same level of familiarity and comfort with the application, the material, the underlying factors, as it did for you in putting it together for that period of time. As we do that review, we are looking at what are the prudential implications, whether it is in compliance with legislation and guidelines, and whether there are any policy implications. In order to do this, we consult with stakeholders. Those may include supervision, actuarial division, the legislative policy and interpretations and compliance team, our capital division, our credit risk division, or others, depending on what the case may require, and only when required. At the same time, externally, we would consult with the Department of Finance if there are potential policy implications. The approvals team itself, I'll say, is expecting the unexpected. We understand that the workflow is not, I'll say, for us to forecast, but we are really at the mercy of when financial institutions want to conduct their transactions that require ministerial or superintendent approval. However, some of our stakeholders have a workload that is more planned throughout the year. And to fit in, I'll say, unexpected approvals work takes a bit of a, I'll say, a balance to find when to fit that into the workload that they have. So that's just an awareness for you of some of the things that happen within sort of any approval that happens. Now I'd like to move to the next slide, please. However, if we look specifically at the contractual provisions for many of the transactions, most contracts do have a condition of closing that all regulatory approvals must be granted. And some of those contracts also require the closing to occur by a certain date. And if not, both parties must agree to extend that date. And finally, rare but may occur is sometimes there is also a financial penalty if the closing does not occur by a certain date. Now, there may be merit to having one or all of these provisions in a contract. And as well, it is good for us to know that these provisions exist within the contractual arrangement. However, we would just like to make clear that an approval would not be granted if there are still outstanding prudential, compliance, or policy issues that need to be resolved. Therefore, there very well may be situations where the penalty may need to be paid, the contract may need to be renegotiated, and that should be factored into, I'll say, the decision to put these provisions in place. Finally, we are noticing a little bit more often now that when we receive an application, there is a recognition that, yes, this timeline is aggressive. However, let's try and see if we can get the approval by our requested date. So all we ask in this situation is that a reminder to please submit your application as early as you can during this process. Next slide, please. So what are some of the considerations that may be, I'll say, unique to certain applications? So we do end up with applications that we find are becoming more complex. We have more applications, this is anecdotally, that have new twists. Something's different. There's a little wrinkle. It's not the same as before. And I would like to say that approvals in OSFI, we welcome the interesting, we welcome the challenging. However, that does take us a little bit more time to understand what are the risks. Are we comfortable with those risks? Are we setting a precedent? What's the impact of that? As well, we are in a unique and challenging economic environment right now due to COVID-19. And part of our assessment of a transaction will be the impact of COVID-19 and the current economic environment on the specific transaction. In addition, some of those internal stakeholders that we would be consulting with are doing work to assess the impact of this very dynamic economic environment on the safety and soundness of our financial institutions. And therefore, as we mentioned again, there are other, I'll say, risks that we are looking at as the office as a whole, in addition to the transaction at hand. And finally, we mentioned that sometimes there are policy considerations. And OSFI tries to bring up potential policy issues with the Department of Finance very early within the process. However, even if there are not policy implications or considerations, the internal process within the department is a standard of 4, closer to 6 weeks for that process to come to fruition. And so therefore, we'd like you to as well keep that in mind when submitting your request for approval. And now I would like to turn it over to Brandon to talk more about some potential solutions. Thank you.
Thank you, Susan. Not necessarily going into solutions, but in addition and related to the topic of timing, I am going to quickly cover some other key observations, starting with the content submitted as part of an application for approval. So on the first point, we see on occasion no reference to information requested as part of the published transaction instructions. In these cases, we take the time to comb through the full submission package to confirm if the required information exists in another part of the package before finally reaching out. And with respect to vague content in the context of required information, I'll give this example. As part of many applications, we need to understand how the transaction fits with the applicant's strategy. We have observed statements similar to the reason for X transaction is that it is part of our strategy. Now, I don't want to prescribe a sentence structure to follow, but I would ask applicants to make reference to the corresponding parts of the strategic plan that are relevant to the transaction. Insufficient depth and breadth. This is similar to being vague, but I would see this as part of information related to analysis, policies, and plans that are submitted as part of the application. For example, a stress test should use adequate levels of stress scenarios and incorporate all relevant variables. Policies and procedures should go beyond the guidance to show how the institution will actually operate and incorporate the parameters and controls in its own context. Business plans should cover the necessary business model building blocks at a level of detail that provides the reader an understanding of not only the potential value, but of the risks that were considered. I understand these observations are one-sided. So let me end this presentation with some information on what we are aiming to do to improve internally and ultimately an applicant's experience with approvals. Continuous improvements in approvals. At an organizational level, OSFI is in its own process of digital evolution to increase agility and improve operational effectiveness. That includes the approvals department's processes and systems. We're looking at ways to increase transparency in application requirements and considerations, as well as in the planning and progress of an application review. And we're looking at ways to improve current risk-based approaches to assessment. And we are looking into ways to further leverage technology to further improve data analysis and operational efficiencies. Finally, we continue in the process of exploring in what ways the financial industry is moving and where the approvals group should adjust to take into account the various business models and their associated risks. So that concludes our group's presentation, and we'll now take a few minutes to answer any questions you may have. So please feel free to once again submit your questions and vote on questions on the Slido app. I see at this time there is one question. And so maybe we'll start with you, Susan. How many new bank applications are there in the pipeline? And how long does it take for an approval?
Oh, well, thank you for the question, Brandon. How many new bank applications are in the pipeline? I'm going to have to rely on you a little bit for banks, but I believe there are several. I believe there's around 7 insurance applications and some that are still, I'll say, yet to come because of the, I'll say, the hard market in insurance. We are getting more. The other thing I think would note with new bank applications is when we talked about the current economic environment and needing to spend some of our resource of time ensuring that the safety and soundness of our existing financial institutions, that has impacted the timing for specifically some of the new bank applications. But Brandon, I don't know if you have anything to add to that.
Yes, at my fingertips, I do not have the exact number, but it is around 10, I would say. In terms of how long does it take for an approval, that definitely does vary, but it is definitely not a short time frame. The next question we have is, what is the link between stress tests and DPTI applications? That's a good question, and I'll take this since I mentioned. This is really in the context of an incorporation, so a new bank application or new trust application, where stress testing is involved. We have another question here. Some international regulators have formal time standards for approvals. Has OSFI considered such a practice? Maybe Patrick?
Yeah, I can take that one, Brandon. Thank you. And thanks for the question. So we do have, as per Treasury Board, we do have performance standards, but they're tied to basically what we control. And what we control is from the time where the application is materially complete or the reseeding date. I recognize that that doesn't give us a whole lot of comfort because it can be a lot of variety, but you know, for OSFI to have performance, you know, or formal standards for approvals when so much of the process depends on the nature of the prudential issues at hand that we need to go through, as well as the level of responsiveness, really, you know, wouldn't sort of, I think, wouldn't necessarily be be helpful. And as far as I know, other international regulators, do have performance standards on things that perhaps are more rules-based than requiring what I just went through. So thank you.
Thank you, Patrick. This one, maybe Susan, you can answer. Is there any way to know ahead of time how best to satisfy the Department of Finance as part of the original application submission?
Okay, yes, well, thank you. It's something that we think about in approvals as well as working closely with our colleagues. To date, we do have regular meetings with the department to talk about upcoming applications that are currently under review to, like we said, flesh out any potential policy issues early on within the process. But we are continuing, I'll say, in the theme of continuous improvement to work together to see if there is a way that we can maybe flesh out even some of the, I'll call it standard types of questions, issues, information, and front load that a little bit earlier in the process. So that's something that we are, I'll say, striving and working and collaborating with Department of Finance over the coming year.
Thank you, Susan. This one we might have to get back to on is how many FBB applications have been approved since last seminar, sorry. Yeah, I think I don't know, maybe Patrick, if you have any data at your fingertips.
No,
right now,
I'm really sorry, I don't have it. Andy, perhaps JP, I'm sorry to call on you there. Would you remember, since you were in the role last year? We can.
If not, yeah. We'll archive that and we'll get back to that with our answers to any other questions. A follow-up question here. Canada cannot be seen to be holding up global transactions. What can be done to ensure this doesn't occur?
I can take that one. I mean, here, I think, first of all, we're involved in several transactions that have a global component. There is a fair bit of coordination, both within Canada and abroad, with the main regulator. I think here OSFI's job is really to, and I think we do that with you, is to make the representations on what is being sought and what impacts would be related to, for example, a missed deadline. We work very closely with our colleagues at the Department of Finance, and this is, in turn communicated to the right individuals. But obviously, all these transactions are ministers' prerogative, and there's only so much we can do. But we do, like I said, we do work closely to make those recommendations and representations. Thank you.
Thank you. Can there be more interaction with the other regulators globally to speed up the approval timeline, or other reliance to speed up the transaction approvals? Let me take a crack at this. This also could be something that our partners in liaison could also help answer in follow-up. But what we do actually have some memorandums of understanding, as well as regular communication, or at least open communication between many different regulators. So where there is a need to contact and to confirm with respect to an application, we do take those steps to do so.
And if I may add, in my experience, the interaction with the other regulators, like the information we get out of this, is typically not what will speed up or slow down. It's obviously an important part of the application, but in my experience, it hasn't been, let's say, a bottleneck to an application.
Thank you. This next question here, can you please comment on when OSFI will require an on-site examination preparedness review other than in the context of a new entry application? Unfortunately, we won't be able to comment on that. That is something that our colleagues in supervision would be privy to. And just moving on to the next question here. Can there be more interaction? No, that one's still there. We'll go to the third question on the screen. As per the Bank Act, OSFI will communicate regularly with the applicant throughout this process. How regular is regular? Good question. Maybe Susan, do you want to take that?
Okay, thank you. So approvals case officers do endeavor to keep applicants up to date, request additional information, and the frequency of those updates, I would say, depends on the complexity, the frequency of new developments. I would say more, we don't have any, I'll say, rules, but in more complex applications, I have seen that it is common to have regular touch points, whether it's, I'll say, once a month, once every 2 weeks, in order to help facilitate the transaction and move things along, especially when there are a lot of moving parts. But we are definitely open to applicants following up and requesting a status update as well. And we are happy to meet with applicants either now in a virtual environment or, you know, over the phone to talk and discuss the application further.
Thank you, Susan. This is all the time we have left for questions. I see there is one remaining question, and we will definitely keep that to answer at a later time. And we will now take a 5-minute break. Please be sure to tune back in at 2:15 p.m. Eastern. See you then. Welcome back, everyone. We'll now move on to an update on policy development from Teresa Hinz, Vlasios Melissanakis, and Jean-Michel Desrosiers. On to you, Teresa.
Great, thank you, Brandon. Hello, everyone. My name is Teresa Hinz, as Brandon mentioned. Also, as mentioned by Judy a little earlier, I took responsibility for the Prudential Policy and Strategic Policy Liaison team last July. A pleasure to be here with you today in this new virtual venue for OSFI's Regulatory Affairs Annual Seminar. As mentioned by Brandon, I am joined today by 2 team colleagues, Vlasios Melissanakis, Director of Prudential Policy, and Jean-Michel Desrosiers, Manager of Strategic Policy Liaison. Vlasios and Jean-Michel will provide overviews of some key work areas in their respective teams in a few minutes. Next slide, please. And the next one, sorry, Brandon. There we go, thank you. But before we do that, I'd like to provide a snapshot of the 18-member group focused on prudential policy development and strategic policy liaison work at OSFI. The group has been in place for a couple of years following a recalibration of the Regulatory Affairs Division. The group is comprised of 2 teams, Prudential Policy, led by Vlasios Melissanakis, and Strategic Policy Liaison, led by Yasser Saeed. Yasser unfortunately could not join us today due to a training leads. An important element in developing the group's responsibilities and priorities over the last couple of years is the OSFI 3-year strategic plan. The plan was initially launched in 2019 and discussed at previous regulatory affairs seminars. You can access it on OSFI's website. Next slide, please. Sorry, Brandon. Yeah, thank you. OSFI's strategic plan sets out 4 key areas of focus: financial institutions' management of financial risks, and a new focus on non-financial risks, OSFI's own operational effectiveness, and enhancing OSFI's accountability to stakeholders through increased transparency, consultations, communications. These 4 strategic goals have played an important role in shaping the content and method for developing prudential policy over these last few years. For example, to increase transparency of OSFI's policy-making process, we have published a forward policy plan last September and again recently in May. This will be an annual publication, likely in the spring, which coincides with the beginning of OSFI's fiscal year and annual priority setting. The forward policy plan also sets out principles that guide OSFI in determining policy priorities. Additionally, we rely increasingly on engaging with stakeholders on emerging policy issues through the use of discussion papers. For example, the recent reinsurance review, technology risk, and climate risk discussion papers. We also seek industry feedback on our policy initiatives through information sessions and roundtables. And thank you to everyone who provided feedback on our recent discussion papers and participated in our industry engagement sessions. These outreaches are very important, and it is by these events that we aim to achieve prudential policy that is responsive, transparent, and fit for purpose. Vlasios will speak to these initiatives in more detail shortly. Next slide, please. The Strategic Policy Liaison Team is equally focused on enhanced engagement and transparency at numerous federal, provincial, and international levels, and supporting OSFI's strategic goals more generally. Core to the team's work is collaboration with key federal partners, such as the Department of Finance, the Bank of Canada, both of whom have joined us here today, CDIC, and FCAC. We meet regularly with these key federal agencies to exchange information on all matters relating to the financial stability of the institutions regulated by OSFI. Additionally, the Strategic Policy Liaison Team supports OSFI's engagement with numerous provincial partners, including with their umbrella associations such as the Canadian Council of Insurance Regulators, the Credit Union Prudential Supervisors Association, and the Canadian Securities Administrators. The pandemic has underscored the benefit of greater collaboration and information sharing between OSFI and our provincial counterparts on a host of policy and supervisory initiatives. We plan on deepening our bilateral relationships with key counterparts, such as the AMF in Quebec, FSRA in Ontario, the BCFSA in BC, to mention a few. Many of the emerging policy issues, such as technology and climate-related risks, are pan-jurisdictional, and collaborative federal-provincial dialogue on these important issues has been invaluable, and the need for strong communication channels will only grow. On the international front, the Strategic Policy Liaison Team plays a crucial role in supporting OSFI's engagement at key international bodies, such as the Financial Stability Board and the IMF. OSFI's engagement at these international standard-setting bodies is important for Canada, as they are key forums for coordinating and promoting effective global regulatory and supervisory policies in the financial sector. Jean-Michel will talk about our specific role at the FSB in a few minutes. With respect to the IMF, the team is involved in coordinating OSFI's response to the Financial Sector Assessment Program, the FSAP, which is an in-depth assessment of the resilience of the Canadian financial sector, including the quality of the regulatory and supervisory framework, and our capacity to manage and resolve financial crises. These assessments take place every 4 years, and we are currently coordinating the implementation of various Canadian specific recommendations to strengthen the resilience of our national financial sector. I will now hand it over to Vlasios to provide an overview of our current prudential policy work. Thank you for joining us today. Over to you, Vlasios.
Thank you, Teresa, and good afternoon, everyone. Good morning to those in Western Canada. My name is Vlasios Melissanakis, and I lead the team that develops guidance in the areas of risk management. I can say before we move on to the next slide that this will be quite a busy year. in our group. The big theme in the year to come, as you will see in a minute, will be our policy work to build a guidance infrastructure for non-financial risks to match our increasing attention and supervisory work in these areas. Next slide, please. First, technology risk, a timely and topical issue, given that I'm reporting to all of you through a screen on my computer. OSFI's discussion paper on technology and related risks was published in September of last year. It was, in fact, the very first OSFI publication of our policy restart following a very lengthy pause due to COVID-19. The paper itself was very broad in scope, covered several areas in technology, including cyber, third-party risk, artificial intelligence, data. There was a 3-month consultation period that ended in December. And essentially, that consultation confirmed broad support for a principles-based, technology-neutral perspective on technology risk management. Just last month, OSFI published a summary of the feedback that we received, along with the next steps. And here is where the significant work I was referring to at the beginning of this presentation comes into play. Now, before I do that, before I get into those details, one area where we have received a number of questions from the industry, from our domestic and international counterparts, is related to Guideline B10 on outsourcing. Of note, as part of our plan, we will be reviewing and amending this guideline. It will, however, be recast as one on third-party risk more broadly, not just outsourcing. Next slide, please. So this slide shows you the timelines for all the various initiatives. By the way, this comes directly from our forward agenda that was published that Teresa mentioned earlier. We've already begun our work to draft guidance in this area. Notably, and first out of the gate, will be to publish a new draft guideline on technology and cyber risk. And this will be for consultation later this fall. As well, issuing an industry letter on operational resilience this summer to start the discussions in this area, and in advance of revising guideline E21 on operational risk also later in the year. Then early in 2022, as mentioned, we will be revising guideline B10 on third-party risk. And we'll also be releasing an industry letter on advanced analytics and model risk, essentially beginning the discussion in this area as well, as an interim step towards revised model risk guidance. And also in 2022, we will be releasing a consultative document on culture and reputation risk. This is the culmination of quite a bit of work in this area by our Culture and Compliance Risk Division colleagues in Toronto. Next slide, please. Next is our work on climate-related risks. And before I proceed, I should note earlier when Ryan was speaking, it was getting very dark here in this part of Ottawa, and it looked like a thunderstorm was brewing. I was getting quite concerned. I only mention this because as I present through this Zoom call, and with the risk of a storm power outage materializing any minute now, the confluence of climate-related risks and technology risks have never been more acute for me than this very moment. My work is filled with dramatic ironies. On climate-related risks then, OSFI's discussion paper in this area was published in January, earlier in the year, with a 3-month consultation period that ended in April. I should note that OSFI has a very unique and refined perspective on climate-related risks, given our prudential mandate. We look at the physical, transition, and liability risks related to climate and how these can potentially be mechanisms to solvency issues for financial institutions. So it is a very specific lens that we use to look at climate-related issues. We're currently analyzing the results of the consultation, and we'll publish a summary of the feedback and next steps later in the fall. Next slide, please. I was joking earlier about the volatile Ottawa weather and technological fragilities I face as I do this presentation. There's probably insurance for such occasions. This is the truth. Appropriate then that I am to discuss insurance and reinsurance next. 2 years ago, OSFI launched a reinsurance review with the issuance of a comprehensive discussion paper. In the paper, we noted very specifically that insurers have increasingly written large policies in Canada and subsequently ceded a significant portion of these risks outside of Canada. This is known as the leveraged business model. And at the time, we proposed a policy limit rule based on the 3 largest policy limits of the insurance company. This received a significant amount of attention and debate within the industry. In June 2019, we issued draft revised guidance B3, which is specifically on sound reinsurance practices, also for public consultation. And following the pause in our policy work due to COVID-19, in November of 2021, we resumed the reinsurance review, and OSFI issued draft guideline B2, large exposures for P&C insurance, also for consultation. Now, of significance throughout all of this, guideline B2, the guideline on large exposures, contained an amended rule which now focused on a maximum loss related to a single insurance exposure and not policy limits. This is a significant refinement in our view, as it is the result of productive dialogue with and feedback from the industry over the past year, and careful consideration of insurance business models and our regulatory objectives. During the consultation period for B2, we have since had additional discussions with industry associations and individual insurance companies, and we thank you sincerely for all of the valuable feedback that was provided to us throughout all of these discussions. OSFI intends to issue finalized guideline B2 as well as guideline B3 on reinsurance in tandem by December 2021, so essentially by the end of this year. We will subsequently hold information sessions for industry. Next slide, please. Just on some other risk management initiatives, in October 2020, OSFI issued a revised guideline E4 for branches. This was the culmination of a couple of years of work, which had been on and off, given the work that was done in corporate governance, off again because of COVID-19, but then on again. This draft guideline consolidates all of the requirements under the previous E4A for insurance companies and E4B for banks. This new principles-based, outcomes-based guideline shifts the focus from chief agents and principal officers, respectively, to the foreign company conducting the business in Canada. Also modernizes the record-keeping requirements, notably those under CUSMA, which Ryan mentioned earlier. Happy to report that the final guideline E4 will be published by the end of this month, so very shortly. And lastly, and certainly not indicative of the attention it receives by the general public and the media, guideline B20 on mortgage underwriting. OSFI issued a letter back in March 2020 proposing a new benchmark for the minimum qualifying rate in Guideline B20. This consultation process was suspended midstream due to COVID-19. We relaunched the consultation in April of this year, but now with an entirely new proposal, the minimum qualifying rate being the greater of contract plus 2% or 5.25%. We confirmed that OSFI would be adopting this new approach last month with an effective date of June 1. So it is now in effect. Of note, the Minister of Finance has also announced that the same approach would be adopted for insured mortgages. Those are mortgages with a down payment of less than 20%. We will be reviewing this qualifying rate at least annually in December, well in advance of the high volume spring season. With that, I turn it over to my colleague, Jean-Michel Desrosiers.
So, merci beaucoup, Vlasios. My name is Jean-Michel Desrosiers. I am a manager in the Strategic Policy and Liaison Group. As mentioned earlier in this presentation, our group is responsible, among other things, to support OSFI's participation to the Financial Stability Board. I will take the next few minutes to provide an overview of the key files OSFI has been involved at the FSB and the priorities going forward. Next slide, please. So before going over the key files we focused on at the FSB over the past year, I thought I may take a minute here to offer an overview of the FSB structure and position OSFI's involvement. Canada is very well represented at the FSB, with OSFI, the Bank of Canada, and the Department of Finance each being members of FSB committees. The FSB is structured such that the plenary and the steering committee provide oversight and governance to 3 standing committees, which are in turn responsible for vulnerability assessments, supervisory response, and implementation monitoring. On top of the org chart here is the plenary, which is the decision-making body of the FSB. It consists of representatives, actually 59 representatives of member countries, international financial institutions, as well as international standard-setting bodies. OSFI, the Bank of Canada, and the Department of Finance all have a seat at the plenary. Underneath plenary is the steering committee, which provides operational guidance between plenary meetings to carry forward the directions of the FSB. OSFI is the only Canadian representative on the steering committee and will often relay the Canadian position on issues that are of interest to our other Canadian partners. And then there are 3 key standing committees. OSFI is a member of the Standing Committee on Supervisory and Regulatory Cooperation of the FSB, also called SRC, which coordinates the work of national financial authorities and international standard-setting bodies. It develops and promotes the implementation of effective regulatory, supervisory, and other financial sector policies. For example, as part of the FSB's work program for 2021, the SRC will review and potentially develop principles or recommendations on regulatory and supervisory approaches to addressing climate risk at financial institutions. Next slide, please. So let's have a quick look now at the key files OSFI has been involved in at the FSB over the past year. First, as was the case for many people around the world, the FSB's agenda has been basically put aside in March 2020 and refocused on the response to the pandemic. Without a surprise, this area was one where OSFI was particularly involved. So the FSB served as a coordination body during the pandemic for individual jurisdictions, but also among the various standard setting bodies. So as such, OSFI was in continuous discussions with SRC and steering committee members to discuss regulatory, fiscal, and monetary response to the pandemic. To assist jurisdictions in responding to the challenges of their respective economies, the SRC has put together a repository of fiscal, monetary, and prudential measures, which provided a toolbox for every jurisdiction to draw from. OSFI has coordinated Canada's contribution to that repository throughout the crisis. We've also been active on the issue of buffer usability. So many jurisdictions like Canada, where usable countercyclical buffers existed prior to the pandemic, lowered those at the onset of the crisis to support lending. Lenders have been using those buffers with caution, and there was a sentiment that the FSB could do something to encourage lenders to use them. And that's what's basically led to an official statement by the FSB last summer, which OSFI also supported, in support of the Basel Committee's statement that a measured drawdown of buffers was both expected and appropriate during this period of stress, and gave some certainty to banks that they'd be given sufficient time to restore buffers, taking into account economic and market conditions, and of course, individual circumstances. After having implemented so many support measures came also the question of when and how those support measures should be phased out. And work is ongoing right now at the FSB, and we've been following this very closely. Different countries have different challenges, and so the FSB's role here will be about providing advice in terms of matters for consideration when deciding on the unwinding of measures, and exchange on strategies adopted by jurisdictions, especially in light of the potential cross-border impacts of unwinding. OSFI has pushed for coordination among standard setting bodies and effective use of resources, given that multiple international bodies are looking at the same issues. And then climate is another area where we've been more active this year. The FSB will serve again as a coordination function here, as numerous bodies are working on climate-related issues, the BCBS, the IIS, IOSCO, and then the Network for Greening the Financial System, also called the NGFS, just to name a few. 2 working groups were formed at the FSB to work on climate issues, and OSFI is a member of both. OSFI's Assistant Superintendent, Jamie Hubbs, also co-chairs the FSB Working Group on Climate Risk, whose mission is to assist authorities in developing their regulatory and supervisory responses to risk arising from climate change and promote consistent approach across sector and jurisdictions. Another stream of work is on climate-related financial disclosures. This will be a central element of the work. As part of its work on climate disclosures, the FSB was asked by the G20 presidency to play a coordinating role by liaising with standard setting bodies and other international parties, and explore better alignment of the climate-related financial disclosure frameworks internationally to enhance coordination of regulatory and supervisory approaches. Next slide. A few more key files that we've been participating on, maybe not directly as in the previous files, but as I mentioned earlier, the work of the FSB was reprioritized in light of the pandemic, but there was a general agreement that on some files, authorities could not afford to be left behind. And a prime example of that is the rise of global stablecoins. Innovation does not necessarily stop even for a global pandemic, so work continued on that. The plan is to first consider the existing regulatory and supervisory approaches to global stablecoins and their suitability for addressing risks to the financial system and market functioning. In Canada, the Bank of Canada sits on the FSB committee on regulatory issues of stablecoins, which is tasked with this work. On the last slide, linked to the theme of cyber resilience is also the work on outsourcing and third-party relationships. The FSB has published a consultation document in 2020 and held a virtual outreach meeting to discuss industry practices, practical challenges, and potential ways to improve coordination among the relevant stakeholders. And based on those findings, the FSB will be looking at potential avenues to strengthen the resiliency of the financial system. And finally, we'll be keeping an eye on the financial benchmark transition process, which is planned to be completed by the end of 2021. Thanks for your time. I'll turn it over to Brendan now.
Thank you, Jean-Michel and Teresa and Vlasios. We do have a number of questions in the Q&A, but at this time, we will need to move forward in the program. And so we will be answering these questions after this seminar. So moving forward, we'll now hear from Andrew Peterson and Michelle John with an update on capital.
Thank you very much, Brandon. So good afternoon, everyone. It's been several years since I've last attended the RAS seminar, but I'm very happy to be participating this afternoon with you. So my name is Andrew Peterson. I'm a director in the Capital Division, and along with my colleague, Michelle John, we'll provide an update on capital and liquidity related requirements for both deposit-taking institutions and insurance companies. Next slide, please. So with respect to deposit-taking institutions' capital and liquidity requirements, we'll cover the COVID-19 pandemic response. We'll also provide an overview of the domestic implementation of the final Basel III reforms and the small and medium-sized bank proportionality initiative. And finally, we'll highlight some of the items on the forward policy agenda. Next slide, please. So this slide provides a brief overview of OSFI's role in preserving the resilience during COVID-19. As a prudential regulator, our focus remains on ensuring that institutions are able to maintain their resilience from both a financial and an operational perspective amidst an uncertain environment such as the COVID-19 pandemic. So a big part of our job is to think about downside risk, and we usually refer to this as severe but plausible scenarios. So the sudden onset of the pandemic in the early part of last year required us to actively reframe when we considered what we considered to be severe but plausible. We also needed to ensure that our approach to regulation and supervision was risk-based and forward-looking in light of the current conditions. Now, another big part of our role as a prudential regulator is to contribute to the public confidence in the financial system. So this is always important, but it was especially significant during the past year, given the uncertainty caused by the pandemic. So as expected, with our initial announcement in March 2020 related to the domestic stability buffer and distributions, we quickly saw a range of needs develop domestically, as well as a range of actions being taken in different jurisdictions. So while we wanted to offer regulatory flexibility to our institutions, it was important for us to develop a framework and principles that allowed us to make decisions as to which type of actions we'd be willing to take. And we basically came up with 3 key principles that led our decision making, which were credible, consistent, necessary, and fit for purpose. So I'll go through each of these in a bit more detail now. So for credible, the key here is not to undermine the reputation of what we've built. We need to be clear about what we are doing and ensure that what remains meets our prudential objectives, but also is aligned with the intent of international standards. For consistent, what we were looking for there is to ensure that we can look across other sectors such that similar risks are getting a similar treatment. An example of that could be, for example, payment deferrals. The next one is necessary. So we are keen to ensure that we have exhausted other reasonable alternatives before offering any changes. And finally, fit for purpose. So the intent would be to ensure that we aren't obscuring the financial condition of firms, such that where changes are made, they can be understood for impact, they assist for risk sensitivity under the current conditions, and that they can be phased out when they are no longer needed. Next slide, please. So this slide provides a timeline of some of the key regulatory adjustments we made during COVID-19 or over the past 15 months. And as you can see, a lot of it took place in the first 6 weeks. So I'll highlight a few of them at this point. So on March 13th, we announced that we were lowering the domestic stability buffer that applies to systemically important banks. We also announced a number of capital conservation requirements that would be applicable to all regulated entities. And finally, we suspended all consultations. In late March and early April, we announced a series of regulatory adjustments. Some of the key ones that I'll highlight today is, for example, the capital relief for loans with payment deferrals, exemptions from the leverage ratio calculation for central bank reserves and certain sovereign issued securities, transitional arrangements for the capital treatment of expected loss provisioning, and the delay of the Basel III implementation domestically. So we unwound some of these measures as financial conditions stabilized and as institutions' operational capacity and management of the current economic challenges were improved. So examples of what was unwound includes the phasing out in August 2020 of the preferential capital treatment for loans and payment deferral, and then an immediate unwinding in April 2021 of the temporary increase in the covered bond limit. So OSFI continues to assess whether to unwind, extend, or otherwise adjust our regulatory relief measures. And in making those decisions, we keep in mind those 4 principles that I noted on the previous slide. Next slide, please. So now to shift gears, I'll talk a little bit more about the Basel III reforms and our domestic implementation. So as conditions started to stabilize in the second half of 2020, we turned our attention back to the policy development work related to the domestic implementation of the final Basel III rules. So this culminated in the launch of a public consultation on March 11, 2021, related to the proposed Basel III changes, as well as to address a number of other policy matters that were not associated with Basel III. So the proposed revisions impacted the capital adequacy requirements guideline, the liquidity adequacy requirements guideline, and the leverage requirements guideline. As well, we proposed changes to tailor our capital and liquidity regimes to ensure that they remain appropriate for smaller and less complex deposit-taking institutions. So together, the proposed changes to OSFI guidance will help foster a more resilient and risk-sensitive regulatory regime that adheres to the Basel III framework and also incorporates adjustments to reflect the Canadian market. So together, the guidelines and chapters that we consulted on constitute a very significant and wide-reaching set of revisions to the capital, leverage, and liquidity frameworks, as well as to the Pillar 3 disclosure guideline for systemically important banks. And so the consultation on most of these areas ended in early June, with the exception of the Pillar 3 disclosure guideline for DSIBs, where the consultation will close in early July. Next slide, please. So as noted, the consultation does cover a wide range of sections of the capital, liquidity, and disclosure guidelines. And so we thought it'd be useful to draw your attention to some of the key policy developments that were covered as part of the consultation material. So I won't go through all of them, but I'll highlight some of the key aspects for you today. So from a credit risk perspective, I'll focus on the capital treatment of privately insured mortgages. So what we proposed there were changes aimed to better align the capital requirements with the structure of the government guarantee under PERMIA. And another point on credit risk is we also made changes to credit card exposures, both with respect to the risk weights and the credit conversion factors. For liquidity, and in particular the net cumulative cash flow, we updated the measure to improve recognition of cash flows for asset growth, such as commitments, as well as operational expenses. Another change we did with respect to the NCCF is we reduced the reporting timeline for small and medium-sized banks from 30 days to 14 days, which aligns with the domestic systemically important banks. Another change is the inclusion of an SMSB capital and liquidity guideline. So this guideline includes our criteria to segment SMSBs into different categories for purposes of determining capital and liquidity requirements. So the new guideline is also a reference tool for stakeholders to help them understand which parts of the CAR, the leverage requirements, and the LAR guideline apply to them. Finally, on Pillar 3, as part of this public consultation, we included a draft Pillar 3 guideline for DSIBs, which aligns with the Basel III reforms. For the small and medium-sized banks, through the consultation, we sought feedback from stakeholders on a proportional set of Pillar 3 disclosure requirements for SMSBs. Next slide, please. So OSFI recently released its near-term plan on guidance priorities until March 31, 2022. So this slide highlights key guidance initiatives related to DTI capital and liquidity. So the first item relates to the domestic implementation of the Basel III reforms and the proportionality requirements for small and medium-sized banks, which we have spoken about on the previous slides. So the final guidance is expected to be released in Q4 2021 for implementation in Q1 2023. An exemption to these implementation timeframes relates to the market risk and CVA requirements, credit valuation adjustment requirements, which won't be implemented until Q1 2024. The second point on the forward agenda we wanted to note is with respect to small and medium-sized bank Pillar 2 proportionality. So in our January 2020 consultative document related to SMSB capital and liquidity proportionality, we indicated that this initiative wouldn't just focus on the Pillar 1 requirements, but also on Pillar 2 and Pillar 3. So we're starting to turn our attention to the Pillar 2 capital and liquidity expectations for SMSBs. And as part of this work, we plan to issue a survey in Q3 2021. So the purpose of the survey is to help inform areas of focus with respect to Pillar 2 capital and liquidity requirements. Finally, OSFI is also considering possible changes to our current regulatory and monitoring practices related to unencumbered assets and pledging activities. Through this work, we plan to issue a consultative document to get stakeholder feedback on possible changes in Q4 2021. Finally, in Q1 2022, we plan to consult on a draft guideline on unencumbered assets and pledging. So this concludes my update on bank capital and liquidity requirements. I will now pass it over to Michelle John to provide an update related to insurance capital requirements.
Thank you. Thank you, Andrew, and good afternoon, everyone. So my name is Michelle John, and I'm a director in the Life Insurance Capital team. As Andrew mentioned, I'll provide an update today on insurance capital. Next slide, please. As you can see on the agenda, I'm not going to cover the COVID-19 responses for insurance, as the measures were largely aligned with the banking, and these were already covered by Andrew. What I am going to cover today is a multi-year project that we have been working on to update our capital framework for the International Financial Reporting Standards, so the IFRS 17 for insurance contracts. I'll talk about a couple other initiatives, and then I'll give a quick update on some international development work. Next slide, please. So I wanted to start today by talking a bit about what our current framework is and talking about why the IFRS 17 is causing us to have to make changes to our capital framework. So as you can see on the slide, the capital framework is largely made up of 3 capital guidelines: the LICAT for life insurance, the MCT for P&C, and the MICAT for mortgage insurance. Now, the other piece that we need to understand is that there are new accounting rules coming in for insurance contracts, and that's the IFRS 17, which will go into place in 2023. We rely on the GAAP accounting basis as the starting point for capital measurement. So because GAAP is changing, we need to adjust our framework. For example, we needed to define the treatment of new elements on the IFRS 17, like the contractual service margins. We needed to make changes for some elements that are measured differently under IFRS 17. So as an example, risk adjustments. So there has been a lot of work to get us to this stage. There have been directed consultations and quantitative impact assessments on draft versions of the guidelines, and many industry and internal discussions. The next step is for us to do a public consultation on the guidelines and the revised capital returns and instructions. This consultation will start next week and will close at the end of September. Once we have launched that public consultation, we will be doing more communication. We'll be engaging with industry and other stakeholders with calls and webinars. For an example, we will have analyst calls, and we'll be doing webinars in mid-July. Next slide, please. So this graphic is just showing sort of our timelines as we lead up to the Jan 1, 2023 implementation date. I will focus on the current milestone, which is highlighted in blue. So that's the June 2021 public and directed consultation. So as I noted, the public consultation on the guideline returns and the instructions starts next week and will close at the end of September. At the same time and in parallel, we are asking insurers to do another quantitative impact assessment, or a quiz, as we call it. Now, this is going to be our final complete quiz. So we are looking for quality submissions. Insurers will have till the end of September to complete most of the package of the quiz, with a few elements that are going to be staggered to October 31st and November 30th to allow more time for insurers to complete these. After we get the quiz results and feedback from the public consultation, we may reach out to insurers for further data calls for calibration and transition purposes. And then our final stage is that we will distribute final guidelines in June 2022 to insurers and select stakeholders, and we'll have the final guidelines up on our website in August 2022. Next slide, please. As I noted earlier, a lot of work has gone on to date, but there's still some capital considerations that we are still discussing and doing further work on. In the life insurance field, two items that we are still, as I said, having ongoing discussions are about achieving neutrality. So it is our aim to minimize the potential industry-wide capital impacts. What we are doing is we are testing some levers that we believe can achieve this in our June consultation. Once we have these results and we do any post-quiz data calls as needed, this will help us finalize our LICAT 2023 calibration. The other item I'll mention with respect to the life industry is volatility. Now, we have not seen higher volatilities at the overall industry level from our prior quiz, but we know that companies were still finalizing their positions. What we want to do is test capital volatility again in the June quiz. So that's what we will do. Now, once we have those results, we will continue to monitor and assess volatility and consider any measures that we might need to dampen it. On the non-life side, we have reviewed the results from the prior quizzes, but we are aware that these were done on a best efforts basis and companies were still developing their policies. We want to review the results from the June quiz and determine if we need any transition or calibration considerations. Next slide, please. So concluding on the IFRS 17, I just wanted to talk about a couple other initiatives that are ongoing. So on the segregated fund guarantees, so this applies for insurance products with seg fund guarantees. OSFI has been developing a new standard approach for capital, and we had planned to implement this new standard approach at 1/1/2023. And you may have seen that in our prior work plans and timelines. After some recent outreach with insurers and internal discussions, we've decided that it would be best to delay the implementation of the standard approach for 2 years. So that's to 1/1/2025, as there's a lot of work to be done by insurers to implement IFRS 17, and we don't want the work on the seg funds to get in the way of a robust implementation of the IFRS 17 standard. What we'll do instead is implement an interim approach, which is quite similar to the current approach for seg fund capital, and that will be used with IFRS 17 until the new standard approach is implemented. I'll just mention quickly that we do have the liquidity risk framework. There's a lot of work ongoing. Sorry, this is a multi-year initiative, which we will kick off later this year. It's part of our continual enhancement to assess this risk and determine whether we need to enhance our framework. We will engage with the industry and other stakeholders once we have made some progress internally. Next slide, please. So I wanted to conclude my statements by just talking about some of our international work. So the IAIS, which is the International Association for Insurance Supervisors, it's a voluntary membership organization of insurance supervisors and regulators from more than 200 jurisdictions. The mission of the IAIS is to promote effective and globally consistent supervision of the insurance industry. OSFI contributes to this work through its active involvement in several IAIS committees and working groups. Some key ongoing initiatives of the IAIS are the development of the Common Framework for Supervision of Internationally Active Insurance Groups, also known as ComFrame. There are currently 3 insurance IAIGs in Canada: Manulife, Sun Life, and Canada Life. Part of ComFrame is to develop an international capital standard, or an ICS. The ICS is currently in a 5-year monitoring period. Now, OSFI is broadly supportive of having that common metric and has been part of the development of the ICS, but there are some key technical areas where we are not currently aligned. We are working with the IAIS to assess if there's scope to refine the methodology. One of our key concerns is the valuation of the business, specifically long-term business. At the same time, we're exploring other options being developed for global standard, notably the aggregation methodology. So with that, I'd like to conclude my update on insurance capital, and I will turn it back to Brandon. Thank you.
Thank you, Michelle. We'll now take about 5 minutes to answer any questions that you may have. Please go ahead and submit your questions on Slido. I see that there are a couple already here. So we'll start with the first one. Thank you, Michael, for putting your name in. BCBS published Prudential Treatment of Crypto Asset Exposures, providing a conservative treatment of crypto assets, including Bitcoin. What are OSFI's? Maybe this for Andrew.
Yep. Thank you very much, Brandon, and thank you very much for the question. I think at this point, it's just worth noting that we're planning to publish a letter related to this document in the near future. And from our perspective, we'd be very interested in hearing from stakeholders on their views related to the BCBS proposals. Thank you for the question.
Thank you. The next question here. Many of us submitted comments with respect to the mandated 100% LGD in the capital treatment of privately insured mortgages. When can we expect a response? This is for Michelle.
I think actually, Brian, this might be more for me as well.
Yeah, sorry.
No problem. So first of all, thank you very much for providing comments through the consultation process. It's really important for us to hear from institutions. So in general, the consultation deadline has just passed about a week and a half ago. So we're really in the process of reviewing all the feedback that's been provided, and we're looking to determine what the next steps are. And if we need to get some clarification with respect to some of the comments, then we will. Other than that, though, I would mention that when we publish the final guidelines for implementation later this year, we will include a summary of comments received during the consultation and our corresponding views and actions as applicable. And when we put the summary of comments, obviously they will be anonymized. Thank you for the question.
Thank you, Andrew. Looks like there are no more questions right now. I'll now turn it back to Judy Cameron to deliver some closing remarks.
Thanks, Brandon, and thanks to all of the participants as well as all of the presenters in today's seminar. Just reflecting on the number of questions we received, which was much higher than we ever get in an in-person seminar. I think that this is another benefit of the virtual format, is that certainly there seems to be a much less anxiety about asking a question, or perhaps it reflects the broader participation that's available. But we we're very happy to hear the interest that there was in the material we were sharing, if we judge that by the number of questions. And as Brandon mentioned, we will be getting back to you with our answers over the coming weeks. Some of them will take a little bit of time to answer, but we were very happy to receive so many questions. And as I mentioned earlier, we covered the questions, so you'll get that in the coming weeks. And then the other thing to look for is that the recording of today's session will be available on our YouTube channel also in a couple of weeks, and we'll email you the link when it's ready for viewing. So that's it from us. Thanks again, and enjoy the rest of your day.